I may have discovered a chart the Federal Reserve is using to determine when it's time for them to stop hawking. And if you are a long-term investor or a trader, I think this chart could be really critical for your investing. It almost perfectly seems to line up with the behavior of the Federal Reserve. Though I will say, I just had the stomach flu last night. It started at like 8 o'clock, and I feel like I lost a fight. Like, I got kidney punched, and like every part of my body hurts. I don't even want to sit here right now, so sorry. The show must go on. Anyway, I hope I'm better, but who knows? Okay, so look, I don't want to bore you, so I want to speed this up for you, okay? You've seen this chart before, but you haven't seen the other two, probably. Mostly because I've only been kind of talking and brainstorming with course members about it, and I'm like, I don't know, is it? And I'm like, oh my gosh, it is. So we've been brainstorming, and it just aligns. It's perfect, almost. It's really interesting. So it's worth noting that Jerome Powell does look at charts like this. This is something that is called the 5-year break-even rate. You've heard that a million times this year. It's you've seen this chart, but you haven't seen the other two. It is basically a measure of the spread between treasury bonds and treasury bonds that are inflation protected. And basically, the higher this number goes, the more the market is seeking inflation protection because they fear that inflation is going to go up. The lower the number goes, the less the market is seeking inflation protection. That's why the spread between the two, the break-evens we call them, can be a market indicator of inflation. You could use the 5-year or the 10-year. They're almost exactly the same. So this is year to date. Obviously, this chart looks pretty good, right? It's clear that we are at the lowest points year to date. And this somewhat aligns with, actually, I would say pretty well aligns with the behavior of the Fed, from Jerome Powell calling war a game changer over here to the war actually really commencing and break-even inflation skyrocketing. And then you get these sort of peaks in the summer as we started having concerns that, wait a minute, like, inflation's coming down. No, it's not. Inflation's coming down. No, it's not. Oh my gosh. And then over here you have Jerome Powell getting a little bit more angry after Jackson Hole, right? So this very much aligns with not only what the Fed says when they talk, but then also the market's expectations of the Fed's actions. So in other words, the more aggressive the Fed is, the more we actually see this line go down. And what I've noticed is the more this line goes up, the fussier J. Powell gets. He wants this line down. And the last press conference was right about here. And I'm like, I don't know, I mean, that's low, right? Ish. I mean, it's not as low as it once was earlier, like the end of September over here, but it's trending down, right? I think the reason Jerome Powell got as aggressive as he was in this last press conference, where he's starting to send the signal that, hey, like, we're not close. Like, we still have a long way to go here. We don't know how long that way is, but he was pretty aggressive in the last FOMC meeting. And their SEP projections, their summary of economic projections data release, was pretty hawkish. And so then I zoomed out for the 5-year. This goes all the way back to 2018 on the left side. And I realized a little bit more, okay, this is why J. Powell's hawking. We can't stay around that level there on the right. It's way too high. In fact, if you extend that line all the way across, you're at 2018 highs over here when J. Powell was potentially going to get fired by Donald Trump for hiking rates. They're looking at this chart going, we have to come down, we have to bring it down. And J. Powell and the Fed U-turn, leading into, obviously, this is the pandemic, but they U-turn at the end of 2018. Now, what's remarkable, and I want you to think about this because it really makes sense of this, okay? The Federal Reserve, where they U-turned at the end of 2018, where do you think it was? You will understand this chart, and then when I zoom out to 20 years, it's going to make a lot more sense. But I want you to think, where did the Federal Reserve U-turn and get more dovish? Remember what I said over here. It's too high for them, so they're being aggressive. Well, if it's too high for them and they're hawking, where do you think they U-turned? The Fed U-turned right here, right at the bottom of the break-evens. So in other words, break-evens had to start coming down. This is about October of 2018. Break-evens start coming down, and the Fed U-turns. All right, we'll pause rate hikes. And inflation expectations go up then because it's like, wait, that could be bad. But then they actually continued to trend down, which is why they kept rates stable. And then, of course, they substantially cut rates. I can perfectly align this here. Their rate cut, their unlimited. And then over here in COVID, where do you think they cut rates? Remember, the Fed's aggressive when the number's high, and then they cut rates when it's really, really low. So if you had to guess, where was March 23rd? It's honestly not a trick question. It's right there. So like, when's the Fed gonna U-turn? Oh, when expectations hit their bottom. Okay, so are we anywhere close to the bottom? Well, we're at a low for 2022 over here, but are we at a low enough level where the Fed can cut? Well, I mean, after all, rates over here, worth noting, we're about 2.5%, right? And rates over here right now are about 4.25%. So we're like way higher. We're way higher. The terminal rate could be double on the right side there. That means we could hike to 5%, right? And that should really drive this break-even expectation down. But now I'm going to zoom out 22 years, and this is remarkable. You ready for this? Okay, well, look at this, folks. Where do you think the Federal Reserve U-turned over on the 20-year chart? Well, they U-turned in about February of 2009, which on the 20-year chart is a little harder for me to pinpoint, but I believe that is right here. So it wasn't perfectly at the bottom, but I think you kind of get the idea here, right? Over here, the Fed U-turn was basically at the bottom. We know in 2018, the Fed U-turn was over here. And if we go to the dot-com era, we know that the Federal Reserve's U-turn was right about here, the beginning of 2023. So look at that, folks. This is a pretty blunt instrument here that kind of tells you exactly when to buy. It's really interesting. So if you want to time the perfect re-entry to the market, if you're heavy in cash, you want to make big money, or you're all in and you're like, dude, I wish I was heavy in cash, right? And you're like, I'm all in. Maybe that new money that you're earning right now, don't put it in yet, right? Look, I'm a personal financial advisor. I'm not your personal financial advisor, so I can't give you personalized financial advice. I don't know your situation, right? You know, you're buying a house tomorrow. Your situation could be different than somebody who's like, I don't need my money for the next 30 years, right? Anyway, so point here is that we probably aren't going to see the rate cuts start when the Fed is, or when the break-evens are this low, because we're still going to have too much residual fear. I would guess if we would get to levels that were in line with 2018, right about here, I think that would be a little bit more acceptable for the Fed to certainly pause, if not even start cutting. Now, the difference between where we sit now and here works out to roughly 0.7 points. So we sit right now at about 219. We need to get all the way down to about 149. So when we get to about a spread of 149, that's probably like high time that they cut. It is possible that they pause before that, because remember, rates over here were 2.5. Rates right now are 4.25. So maybe this number goes down to 1, which we're on our way to going down to 1. I wouldn't be surprised that within a month, within 30 days, we're probably, at least if this trend continues, we're probably going to be under 1. And that would, in my opinion, potentially align with the Fed pausing Feb 1. That would be enough for a pause. Now, there's a danger. What if the Fed pauses and then the market skyrockets, right? So the Fed can manipulate this. What they'll do is they might say something like, you know, they'll send Nikki Leaks a text, or they'll do some press thing like, oh yeah, you know, some people are talking about pausing in February, right? All it takes is a little hint like that. And then, like, I think they all get around like it's a football game or something. They're like, all right, let's see what happens. All right, they just went on CNBC or Bloomberg. Let's see what happens to the break-evens. Oh, it's going up. Oh, no. Okay, no, we can't do that. If it stays stable or it goes down, oh, yeah, it's going down. You know, like, that sounds simplistic, but I believe it. It almost aligns perfectly with history. It aligns with the Federal Reserve's behavior, like when they're going to be hawkish and when not. And I think you could use this tool for trading or long-term investing quite well. Now, it's no guarantee. You could always use the 4 most dangerous words of investing. This time is different, but this is a pretty good one. Anyway, thanks so much for watching, folks. We'll see you in the next one. Good luck. Oh, and subscribe and share if you haven't already. Helps out the channel. Thanks.